Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the complicated financial mumbo jumbo for you. Today we're diving into Repare Therapeutics' latest quarterly report, and let me tell you, things are definitely interesting. Stick around, you won't want to miss what we found before we jump in. If you like getting the real story behind these corporate reports without all the fluff, make sure you are subscribed. And hey, we've got a growing community over on Discord to keep the conversation going. You'll find the link in the description below. So, Repare Therapeutics filed their quarterly report, a 10Q, for the period ending the 30th of September 2025. This report gives us a snapshot of how the company is doing financially and what is going on behind the scenes. Let's start by looking at the balance sheet as of the 30th of September 2025. One of the first things that jumps out are the current assets. Their cash and cash equivalents stand at $72.8 million, which is down from $84.7 million at the end of 2024. Marketable securities also saw a drop from $68 million down to around $39.8 million. This suggests they might be using up cash or investing it elsewhere. Total assets are $126.7 million, down from $176.5 million at the end of last year. On the liabilities side, current liabilities are $11.6 million, down from $25.3 million. Notably, their total shareholders' equity has decreased significantly from $151.1 million at the end of 2024 to $115.1 million as of the 30th of September 2025. A big part of this is the accumulated deficit, which has grown to a substantial $461.3 million. That is a lot of red ink. Now let's look at how they've been performing. For the 3 months ending the 30th of September 2025, they actually reported a net income of $3.3 million. That sounds good, right? But it is important to remember that this was largely due to a gain on the termination of a collaboration agreement, which brought in $3.3 million. Without that one-time boost, they would have been in the red. Total revenue was $11.6 million, which came entirely from collaboration agreements. For the 9 months ending the 30th of September 2025, the story is different. They reported a net loss of $43.5 million. That contrasts sharply with the same period in 2024, when they had a larger loss of $56 million. So, while the year-to-date loss is still significant, it is less than last year. Looking at the shareholder equity section, we can see the ebb and flow of their financial situation. The total shareholders' equity has decreased over the period mainly due to accumulated losses. The number of common shares outstanding has increased, driven by things like stock options being exercised and shares issued under their employee share purchase plan. It is clear they are issuing new shares, which can dilute existing shareholders' ownership. This cash flow statement tells us where the money is coming from and going. For the 9 months ending the 30th of September 2025, they used $42.8 million in operating activities. This is less than the $49.1 million they used in the same period in 2024, which is a positive sign. They also saw a significant inflow from investing activities, mostly from selling marketable securities. Financing activities provided a small amount of cash, mainly from their employee share purchase plan. A big event happened on May 1st, 2025. Repare Out licensed its early-stage discovery platforms to DCX Biotherapeutics Corporation. This deal brought in a $1 million upfront payment, with another $3 million expected soon. Plus, Repare got almost 10% of DCX's stock, along with some special rights to keep their ownership percentage from getting too diluted. This transaction resulted in a substantial gain of $5.7 million recognized in the second quarter of 2025. This shows the company is actively trying to monetize its assets. Following that licensing deal, Repare now has a $1.6 million equity investment in DCX. They aren't really controlling DCX or having much influence over it, so they are accounting for it as an investment. It shows they are thinking about value even when they sell off parts of their business. When we look at how Repare values its assets, especially its cash and investments, we see a lot of level 2 and some level 3 inputs. Level 2 means they are using observable market data, which is good. Level 3 means they are using their own unobservable inputs, like pricing models. This is common for complex things like derivative financial assets, which they have here related to those anti-dilution rights from the DCX deal. It is a small amount, but it shows they are managing these rights carefully. The company has been going through some significant restructuring. Back in August 2024, they cut about 25% of their workforce to focus on their clinical programs. Then, in early 2025, they announced even more sweeping changes, planning to cut their workforce by about 75% by the end of 2025. This led to restructuring costs of about $8.5 million in the first 9 months of 2025, including severance and accelerated depreciation of their lab equipment. This is a clear sign they are trying to cut costs and streamline operations, likely due to financial pressures or a shift in strategy. Big news on the collaboration front: on the 15th of July 2025, Repare inked a worldwide license agreement with Debiopharm for their candidate lunresertib. This deal brought in a $10 million upfront payment and another $1.6 million for clinical trial materials. They could get up to $257 million more in milestones and royalties later. This agreement effectively terminated their prior collaboration with Debiopharm, but the company booked a $3.3 million gain from that termination, recognizing some previously deferred costs. This looks like a smart move, bringing in cash and focusing on specific programs. Looking at revenue, they reported $11.6 million for the third quarter of 2025, thanks to that Debiopharm deal. For the 9 months, the revenue was $11.9 million, down from a whopping $53.5 million in 2024. That huge drop is mostly because the big collaboration with Roche, which brought in a massive $50.9 million in 2024, ended. Speaking of Roche, that agreement, which was a big revenue driver in 2024, ended in May 2024. Repare got a $40 million milestone payment in early 2024 from Roche, and they recognized all remaining deferred revenue from that collaboration by the end of 2024. The restructuring and out-licensing deals had a big impact on their research and development expenses. For the 9 months ending the 30th of September 2025, R&D expenses were $42.1 million, a significant decrease from $91.5 million in the same period in 2024. This drop is due to several factors, including lower personnel costs and the winding down of certain programs like lunresertib. This aligns with their strategy to focus on fewer, more promising clinical stage assets. General and administrative expenses also saw a decrease, falling from $23.4 million to $18.2 million for the 9 months. This is mainly due to lower personnel costs, likely a result of the workforce reductions. Now, for the biggest news, on the 14th of November 2025, Repare announced they have entered into an agreement to be acquired by Therapeutics. The deal involves a cash payment per S-hair, which will be determined by the company's cash balance at closing. On top of that, each shareholder will get a contingent value right, or CVR, which could pay out more cash later. They expect this deal to close in the first quarter of 2026. This is a pretty significant development, and it means they are likely winding down operations in preparation for the acquisition. As of the 30th of September 2025, Repare had $112.6 million in cash equivalents, and marketable securities. They believe this is enough to fund operations through 2027, but they do acknowledge that this is based on assumptions that could prove wrong. They have a history of significant operating losses, and their accumulated deficit is substantial. Looking back at the cash they use for operations, it decreased from $49.1 million in the first 9 months of 2024 to $42.8 million in the same period of 2025. That is a step in the right direction, aided by the restructuring and some favorable cash movements. Investing activities were a source of cash, with $30.7 million coming in during the first 9 months of 2025, primarily from selling off marketable securities. This suggests they are liquidating some of their holdings. The report does touch on some broader risks like international trade policies and their impact on supply chains, which is always a concern for companies operating globally. They mention potential disruptions and increased costs due to tariffs, especially with suppliers in China. And with that Xeno acquisition on the horizon, there is always the risk of shareholder litigation or other legal hurdles that could delay or even derail the deal. They've also outlined the risks associated with the CVRs, basically saying there is no guarantee of any payout from them. So, what is the big picture here? Repare Therapeutics has clearly been going through a major transformation. They've restructured their operations, cut their workforce, and out-licensed key assets to bring in cash and focus their efforts. The Debiopharm deal looks promising for future revenue, and the acquisition by Therapeutics signifies an end of an era as an independent company. From a financial perspective, while the year-to-date loss is improving, the accumulated deficit is still a huge number, highlighting the long road to profitability for biotech companies. The sale of assets like the discovery platforms and the lunresertib program shows a strategic pivot, likely driven by the need to conserve cash and maximize value for shareholders, especially with the acquisition pending. The CVRs in the Xeno deal are interesting. They're a way to offer shareholders potential future upside without a huge upfront cash commitment from Xeno, but they also carry no guarantee, meaning shareholders could get nothing from them. It is a classic biotech play trying to retain value through contingent payments. Overall, Repare is navigating a challenging period with significant restructuring and a pending acquisition. The focus seems to be on consolidating, generating some cash flow, and moving towards a sale. The success of this acquisition will ultimately determine the value delivered to shareholders. Alright, that is our breakdown of Repare Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.